What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to do some stock analysis for Disney stock. This stock has recently been on a pretty nice run. In the last 3 months, we have the stock up 26%, and today the stock was up over 6%. So, Disney is now a $197 billion company. I used to own this stock, and I sold out at about a year ago at $95, $93 a share, just because the stock really wasn't moving. It was not doing much. It was taking too long to recover. They were still losing money on the streaming services, and the theme parks were not bringing in enough profits. So I just kind of got sick of it. I wanted to go a more conventional route, and that's why I sold. But if we look at where Disney is at today, the reason the stock is up is because the stock, it showed streaming growth as well as good guidance, and they beat on EPS and they beat on revenue, as you can see right here. So those numbers were good. They said the theme parks revenue was down, I believe. Yeah. Oh, no. Oh, theme park revenue was up 1%. Okay. It grew 1% to 8.2 billion. And they said the next couple of quarters might have a small slowdown in attendance. Okay. So those are the things to consider there. Then we take a look at their revenue and net income. We can see that the revenue has been fine, right? The last couple of years, in the last 12 months, they're doing $91 billion of revenue. So revenue is not a huge issue here, but if we go down to net income, we can see that's where there was a bit of a struggle. And right when they came out with the streaming services, they were losing billions of dollars. Now it looks like they're finally starting to get some good numbers coming in. And in the last 12 months, we have $5 billion of net income. Okay, so that's a good thing. Free cash flow looks good. The debt and the cash does not look good. $38 billion of debt and only $6 billion in cash. That's not very good. That's not a very healthy ratio there, but it is what it is. That's why they got some work to do. Return on capital, 2%. That is really bad. So that's nothing that we want to see. What else do we want to look at? Let's look at what analysts have them doing. 4% revenue growth for this year and next year. EPS is expected to go from $5.4 this year to $5.7 next year. Very small growth, but at least it's headed in the right direction. And their PE ratio the last couple years has been really high, pretty much because their earnings dropped so much, their net income was so low, and the stock the stock definitely fell, but it can only fall so much. It's not going to go to a $20 stock just because their earnings dropped that much. So that's why we see them trading at 40, 50, 70 times earnings. Right now it's at 39. Not too bad. It's actually cheaper than where it's been in the last couple years, but really even 39 times earnings is a lot. I think people are just still expecting their earnings to come back, and they're kind of pricing that in. And so that's where it's like, if Disney wants to be a $200 stock, they better put up some huge numbers. They need huge profitability, or they need some huge growth vectors. And that's really the only way I see them getting back to that price. Now, the good news is that if we look at the super investors portfolios here, we can see that Disney was the third most bought stock in the last quarter with 8 buys. Okay, we can even see what companies and people were buying it. So all these companies right here, all were buying Disney. Okay, it looks like a couple of them actually sold a little bit, just a couple percent, but most companies were buying into Disney stock. So that is also a pretty good sign there. I mean, as for me, I would say if we do have a stock market correction soon and this stock comes down to, let's say, I don't know, under $90, really, I like it under 90. If I can get it under 90, then I might be interested. But right now, I'm not too interested. I don't know. I don't see it. Why am I paying here? Let's do the math here. If we have $108 stock and they're going to do $5.7. Oh, okay. I guess that's a little better. So I'm paying 19 times forward earnings. That's not bad. I think, okay, so maybe that one number that we just looked at was off a little bit. 19 times is fine. That's not bad at all, even though they're not growing much. Yeah, forward PE 19. Trailing PE, look at that. Those numbers are insane. 20, yeah. So 19, that's not too bad. If it fell down to $90 a share or so, then I'd be interested in buying because it's Disney. But I would not expect too big of numbers as far as stock market gains go, as far as the stock price. I wouldn't say I would not expect big gains with this one. But thank you for watching Stock Talk with Nico Criticos. I will see you in the next video.